Welcome to Kings and Queens Accounting class. Once again, we are appreciative of all of you who have found these lessons valuable and have been using them to improve your abilities in accounting. Today, we are now going to be looking at another lesson, and it's about managing accounts receivable and accounts payable. A very important set of concepts that all businesses have to interface because they carry on different transactions, whether they be cash transactions or there be credit transactions. Businesses, the greatest and perhaps the most important intention is to be able to sell their goods and services with the hope that they will receive a return, right, that will benefit the operation of the business. So organizations tend to carry out their business either doing cash transactions only, or they do cash and cash and credit transactions. To proceed with this lesson, we're going to be looking at these objectives. As per usual, we like to be guided by a set of objectives to lead our discourse. So we want to define accounts receivable and accounts payable, interpret transaction relating to accounts receivable and payable, and to use double entry to record transactions relating to accounts receivables and payables. So let's begin. So what then is accounts receivable? The other name for accounts receivable is debtors. Some person might know it quite well as debtors. Now, these are customers. Debtors or accounts receivables are really your debtors, or your customers rather, your credit customers. So this concept has to do with your credit customers or clients. Okay? Your credit customers or clients. That is, you are selling them goods or services on credit, and therefore they are owing you for whatever goods and services that you have offered. As I said earlier, this becomes relevant and important to businesses because their intention is to pass on the goods and the services to their customers or consumers. That's the intention of the business, to get the goods in the hands of the customers and the clients. Why? Because having the goods in the hands of the customers, there is a greater possibility and likelihood that you will obtain payment for the goods. When the goods are in your business, they're tying up your capital so that it will reduce your cash flow. But as soon as you're able to move the goods to the customers, yes, then you have the chance now of liquidating, of obtaining cash from the customers. So that is why businesses do credit transaction, with the hope that they will get payment for their goods. So accounts receivables are also called debtors, and really it is your credit customers or clients. In other words, you have sold them goods or items on credit. You sold it, whether it be goods or it may be any other asset on credit. And so they are owing you. So once we talk about accounts receivable or debtors, it means that the customers are owing the business. They are owing the business. Very important. So they have gotten the goods or the service, and the customers have not paid yet. Let's now go to accounts payable. Now, accounts payable is also referred to as your creditors. So they are also called creditors. Now, these individuals or company or persons, we, the business, would have bought goods or as other assets, yes, on credit. Now, so these individuals are, we could also say they are our credit suppliers. They are our credit suppliers. So we bought goods or any other asset on credit from them, or if we bought services from them on credit, they become our accounts payable or creditors. And what that is indicating that what it is indicating is that we need to pay these suppliers for the goods and services. So accounts payables relates to whenever we buy or bought goods or any other assets or services on credit. So really they are credit transactions, yes? So we get the supplies from them, and they will have given us some time to pay them. All right? So now that we have established then the understanding of the two important concepts, accounts receivable, or they're also referred to as debtors, and this classification really arises from the fact that we are selling goods on credit to customers or clients, goods and services. So we say they are our credit customers and clients. So the customers are owing the business for those goods and services offered to them. The accounts payable or creditors, yes, they are our suppliers. We are getting goods and services from them on credit. All right, let's go on now to our second objective. That is to interpret the transactions. So let's deal with some transactions. Now, first of all, we're going to look at a transaction relating to our creditors. So for example, 2020, November 1st, we bought goods on credit from Max Limited, and the amount is, let us say, $7,000. And the second transaction, November Call that November 3. We bought fixtures on credit from K1 for a total of $4,000. November, let's say November 5, we bought goods on credit from M small, a total of $900. We're continuing. November, let's say November 6, we sold goods on credit to Mills, $450. November 10, sold machinery or machines on credit to J. Paul, an amount for $3,000. And the final one we're going to put on is November 15, sold goods on credit to Ford Limited, $7,500. Now, ladies and gentlemen, let's go. So we have placed the transactions on the board. To distinguish them, we're going to underline the date so you're aware and separate the information somehow that you know the date to make it a little bit clearer. So the first transaction says we bought goods on credit from Max Limited, $7,000. We're going to be interpreting. Our previous lesson indicated the strategy, the rule, or the guideline in approaching double entry transactions. And we say that you ask yourself at least 2 questions to be able to determine the 2 accounts affected in the transaction, so that then you can now record it in the double entry. So let's do that exercise with these credit transactions. Let's go. So we bought goods on credit. We bought goods on credit from Max Limited. So the question we're going to ask ourselves would be, what are we buying? And the answer would be goods. And if we're buying goods, bought goods, then it would be the purchases account. And who are we buying it from? Max Limited. So the next account would be Max Limited. Let's go again. November 3, we bought fixtures and credit from K1. Now the question is, what are we buying? We're buying fixtures. So fixture account is open. From whom are we buying it? From K1. So we have identified those 2 accounts. Let's go on a little further. We bought goods on credit from M small. What are we buying? Goods. And once we're buying goods again, what do we say we open? A purchases account. Very good. That means you have been getting it quite well. So it's a purchases account we open. And who we buying it from? M small. All right. Now all 3 transactions from November 1, November 3, and November 5 are dealing with accounts payable. They are accounts payable transactions. Why do I say that? We are having our suppliers giving us goods and asset on credit. Yes, they are giving us asset on credit. And so they're giving us asset on credit. And so, ladies and gentlemen, boys and girls, in that effect, they are referred to as accounts payables. At this time then, we want you to follow through with us. Yes. The second set of transactions are in relation to accounts receivable. Accounts, what did I say again? Accounts receivable. That is November 6, November 10, and November 15. Why are they accounts receivable transactions? We are selling goods and assets on credit to our customers. So they are referred to as our credit customers. All right. So let's go. We sold goods on credit. So sold goods there will mean sales. And on credit, we are selling it to mills. So who are we selling it to? Mills. November 10. Sold goods, sold machinery on credit to J. Paul. What are we selling? Machine. To whom are we selling it? J. Paul. Sold goods on credit to Ford Limited. What are we selling? Goods. So it's going to be sales account. And from whom are we selling it? Ford Limited. All right. So we have identified then the individuals, we have identified the accounts affected in these accounts receivables and accounts payable transactions. Our final double entry recording final objective rather is to use these transactions now and to open the double entry. So let us proceed with number 1. So we would have a purchases account open, and then we are going to be having, in this transaction we said purchases and Max Limited, so we are going to open Max Limited account. And our purchases account. All right. So the accounting rule, I'm going to replace again. It says accounts that receives, we debit. Accounts that gives, we credit. So we bought goods on credit from Max Limited. What are we receiving? We're receiving the goods. So accounts that receives, we debit. So we go to the purchases account and we debit. So it is November 1st. The name of the other account is Max. So we're going to go right Max Limited in the center. The amount of money is $7,000 and we're recording the $7,000. Then if we debit in this account, as we say, there's an opposite relationship. If we debit here, once we debit here, we're going to be crediting here. So it is going to be November 1st. And the name of the other account is purchases. And it is $7,000. So we have recorded as it relates to this transaction. The second transaction indicates that we bought fixtures and credit from Wong. So the two accounts affected is be fixtures and Wong. We need to open an account for fixtures And we also need to open an account for one. For space, I'm going to remove these. So we're going to open an account for one, which is K1. K1 account. Now, we are buying the fixtures. So what are we receiving? The fixtures. So we're going to debit because accounts that receives we debit. So in the fixtures account, we're going to record on the debit side, November what now? 3 or 3rd. And the name of the person is K Wong. And the amount of money is $4,000. If we debit this account, which is fixtures, we're getting it from Wong. So Wong is giving it, account that gives we credit. So we go to Wong account right on the debit side, November 3rd. Yes, November 3rd. The name of the other account, fixtures. And that amount is $4,000. Let's take the other one, which is we bought goods and credit from Small, so we need to open now Small's account. Alright, so M Small. Now we have a purchases account already, so we don't need to draw up another one. So we are buying the goods, so once we're receiving the goods, we're going to debit, so it's going to be November 5, and it is going to be M Small, and the amount is $4,000, am I right? No, $900. $900. So we debit, yes. We're getting the goods from M Small, so M Small is giving it, we're going to credit his account. November 5, and it's going to be purchases, and the amount is $900. So, ladies and gentlemen, boys and girls, we would have recorded the transactions in the double entry for the accounts payables. Now, who are the creditors that we have here? 1, K1, 2, M Small, and 3, Max Limited. These 3 persons are businesses, business and persons would have been our creditors. And then what would have been the total creditors, total credit that we have, total value of the creditors? It will be 4,000 plus 900, that is 4,900. 4,900 plus the 7,000, which is going to be now what now? 11,000. Yes? 11,900. So the total of our creditors, value of our total creditors would have been $11,900. That is what we would have owed. 11,900. But how do we come to this? We add this figure, and this figure, right? And they gives us $11,900. The total debtors or the total accounts receivable would have been 11,900. This is the accounts for that. All right, so we're going to now look at the other 3 transactions relating to accounts receivables. These were accounts payable. Now, it says we sold goods on credit to M Mills, so we'll open an account for sales. Yes, sales account. We're also going to be opening an account for mills. All right, that is this transaction we're dealing with right now. Sold goods and credit to mills. So what are we selling? Goods. So our receiving and giving, no, we're giving, we're not receiving, because we're selling the goods. Accounts that gives credit. So in the sales account, we'll credit it. November 6, mills, and the amount of money is $900. We debit credit in that account. We're going to debit in this one, November 6, sales, $900. All right. Next transaction said we sold goods on credit to J. Paul. So we're going sold machine. Have me excuse. Sold machine. So it's going to be that we open our machine account. And we're going to open an account for J. Paul. Right? So if we're selling the machine is leaving us, so we're giving it. Accounts that gives with credit. So in the machine account, we're going to credit it, yes? So it would have been November 10. And we're going to have J. Paul here. We're selling it to J. Paul. And that amount is $3,000. And then J. Paul is receiving it, so we're going to debit. Accounts that receives, we debit. So we're going to have November 10, yes, machine, and it's going to be $3,000. The final transaction says that we sold goods and credit to Ford Limited. So it was sales account and Ford Limited. So we go to sales account, November 15, yes, and we are going to have what now? Ford Limited for how much? $7,500. Then we'll open an account down here for Ford Limited. So Ford Limited account. We credit in this account, in a sales account, we must debit here, which November 15, and it is a sales item, and it's 7,500. Now, so this would cover the total for the accounts receivables. These transactions are related to accounts receivable transactions. All right. Now, what is the total of our accounts receivable from these transactions that we have conducted? It would be 10,000. Is it 10? Yes, 10,950. Again, we're going to add these are our accounts receivable mills, yes, and Paul and Ford. These individuals or companies would refer to our accounts receivable customers, yes, right? And so the total would be, I have 3,000, yes, 3,000, and so this is 10, so it's 10,000. Did I make an error earlier? This should have been 450. Have me excuse, it should have been 450. Let me correct it. 450. This transaction 450. Good. So then the total for the total account receivable, the total would be this plus this, which will be, that will be 10,500. There's the 10,950 will be total accounts receivable. All right. Ladies and gentlemen, boys and girls, thank you very much for sharing with us today. In this session, we sought to explain these transactions relating to our accounts receivables and our accounts payables, otherwise called our debtors and creditors. Once the business is selling goods on credit, then they are going to be obtaining debtors or accounts receivables. Once the business is selling items, buying on items on credit, then we are going to have our accounts payables or what we call our creditors. All right. And so we would have shared with you, okay, the definition in respect of it. Would have also of these two concepts, and we would have showed you the transactions and have recorded how they are done in the double entry system. Thank you very much for sharing with us. It was a pleasure really to share with you all. I hope this lesson has helped you quite a bit to unravel the uncertainties that you have had in relation to these concepts. And we try our best not just to explain the concept, but to be practical, to show the working out of the concept so that you can understand and follow through with the transactions. We appreciate you. Please like and subscribe below this video and show your love to this session or this group referred to as the Kings and Queens Accounting Class. Thank you very much and have a wonderful day.